If you have reached age 60 or older and are currently receiving Social Security or any form of retirement pay, pay close attention because a shift is occurring in Washington that could influence how much the IRS claims from your checks. The majority of retirees are still completely unaware of these developments. Senator Bernie Sanders has recently addressed this issue, and his statements on the Senate floor have raised concerns within both major political parties. Currently, a proposed adjustment to IRS regulations is moving quietly through the legislative process. There are no prominent news headlines or primetime reports covering this yet. Instead, these are policy shifts being formulated behind the scenes that could potentially cost retired citizens thousands of dollars in funds they have already earned and been taxed on. We are looking at potential modifications to how retirement account withdrawals, pension payments, and Social Security distributions are reported and potentially taxed as early as the coming year. Sanders is speaking out about this, and truthfully, you should be concerned as well. This is because the reality of the situation is rarely explained in simple terms. Seniors who grasp these changes early have a genuine chance to protect their wealth before new rules are implemented. Those who stay uninformed might only realize the consequences when they receive a tax bill that is much higher than anticipated. In this presentation, we will analyze what this proposed change actually involves, the specifics of Sanders' remarks, and 3 critical steps that financial experts are advising everyone over 60 to evaluate immediately. You dedicated decades to building this nest egg. Do not allow a regulatory change to quietly diminish it. Please like this video so other seniors can find this information while there is still a window to take action. Let us increase awareness together. Before we proceed, understand this clearly. This is not a matter of partisan politics. It does not matter which political party you have supported in the past, or if you stay away from voting altogether. The actions taking place within the IRS impact every single retired person in America, regardless of their political views. So settle in, focus, and let us examine the facts together, because this is a situation where lacking the details can result in significant financial loss. Let us start with Bernie Sanders, as his involvement is central to this discussion, and many are curious about his specific comments and why they carry weight. Sanders, the independent senator from Vermont, known for his long history of supporting working-class families and retirees, recently issued a direct statement regarding the direction the IRS seems to be moving. He is not someone who shyly hides his views. For years, he has been vocal about issues that others might ignore. However, what makes this moment unique is that people from all political backgrounds are listening, because his points affect millions of retirees living on fixed budgets. Sanders explained in plain language that the IRS has been steadily altering how it monitors, categorizes, and potentially taxes retirement wealth. Specifically, they are looking at the income sources that retirees rely on the most. This includes Social Security, 401k, distributions, pension checks, IRA payouts, and even certain types of annuities. These are not extra luxury funds. They are the financial pillars that seniors constructed through a lifetime of labor. Now, adjustments being made within the system could alter how that wealth is tracked and how much of it you actually get to keep. Now let us clarify a vital point, because there is significant confusion spreading online. This is not a situation where the IRS is suddenly launching aggressive raids or knocking on seniors' doors. That is not what is happening. What this represents is a much quieter but potentially more significant impact. It is a slow administrative transition in the way retirement wealth is defined and reviewed. These types of shifts can lead to serious financial outcomes for individuals who are not actively monitoring the situation or who do not have professional help navigating the bureaucracy. To grasp this fully, we need to look at the history. For many decades, the taxation of Social Security has followed a framework created in 1983 and modified in 1993. Under that logic, up to 50% of your benefits could be taxed once your earnings hit certain levels, and up to 85% could be taxed at higher brackets. Here is the primary problem that is rarely mentioned. Those income limits have never been adjusted for inflation. Not one single time. When they were first set, they represented the economic conditions of that era. Today, after decades of rising prices and increased costs of living, a much larger number of seniors are hitting those tax brackets. This isn't because they have become wealthy, but because prices have risen, while the tax thresholds have remained completely frozen. This phenomenon is called bracket creep, and it has been silently draining more money from retirees every passing year. The current worry is that new IRS changes might introduce even more layers of difficulty to an already confusing system. Complexity almost always creates a disadvantage for the average citizen. When regulations become harder to grasp, errors become more frequent. When errors rise, penalties usually follow. And as penalties accumulate, more money is taken from retirees and sent back to the government treasury. This is not about a hidden conspiracy. It is simply how large, complex bureaucracies tend to operate. Sanders is one of the few prominent figures openly calling attention to this trend. One primary area of concern involves provisional income, which is the figure that determines how much of your Social Security is subject to tax. This calculation includes your adjusted gross income, any interest that is tax-exempt, and half of your total Social Security benefits. As reporting rules change and definitions become stricter, more retirees may cross these limits without realizing it, increasing their total tax bill. For anyone on a fixed income, a surprise tax charge is not just annoying. It can force difficult choices between medicine, food, or heating. The consequences are very tangible. Another significant factor is required minimum distributions, or RMDs. If you own a traditional IRA or 401k, the IRS mandates that you start taking money out at a specific age. That age has already changed recently due to new laws like the Secure Act. The basic idea is simple. Taxes were postponed for years, and now the government wants its share. However, the way RMDs interact with Social Security taxes and Medicare costs creates a domino effect that many people do not see coming. For instance, a senior starts taking their RMD. That withdrawal raises their total income. That higher income then makes more of their Social Security taxable. If that income crosses certain Medicare limits, their Part B and Part D costs also go up through surcharges known as IRMA. A single withdrawal can trigger a chain reaction of costs. With the IRS tightening how these numbers are tracked, the room for error is shrinking while the financial stakes are rising. Sanders has argued that this growing pressure shows a failure to update policies for the modern retiree. He has advocated for lowering or removing Social Security taxes for those with low to middle incomes. He has also questioned the way the IRS uses its enforcement budget, particularly after receiving new funding recently. A major concern is whether these efforts will unfairly target average citizens instead of wealthy individuals with complex tax shelters. Historically, middle-income earners have often seen higher audit rates because their paperwork is simpler for the government to process. This creates a reality where normal retirees may face more pressure than people with much higher wealth. So, what practical steps can you take? This is the most vital part. Experts who focus on retirement strategy consistently suggest starting with one major move. Know your provisional income today. Calculate your adjusted gross earnings, add in your tax-free interest, and include half of your Social Security. If you are close to the $25,000 mark for individuals or the $32,000 mark for couples, you must stay alert. Going over these limits increases your tax liability. One common strategy is the Roth conversion. Moving money from a standard IRA to a Roth means you pay tax now, but your future withdrawals are tax-free. These payouts do not count toward your provisional income, which helps control Social Security taxes and Medicare premiums. Another path is a qualified longevity annuity contract, which lets you postpone some of your retirement wealth from RMD rules until later in life. There are also qualified charitable distributions, which allow you to send money directly from an IRA to a nonprofit without it counting as taxable earnings. These methods can lower your total tax exposure if applied correctly. Organization is also essential. Save every 1099-R form you receive. Track your after-tax contributions using the correct IRS forms and keep clear records of any Roth conversions. Without accurate data, you might accidentally pay tax on money that was already cleared. Furthermore, stay vigilant against fraud. The IRS will never contact you via phone, email, or social media to demand immediate funds. Any such interaction is a scam and should be reported through official government channels. Looking at the broader context, these changes are happening as millions of people enter retirement, which puts significant strain on the system. The debate over policy is becoming more intense, with some wanting more benefits and others focusing on government revenue. The final result will impact retirement safety for many years to come. Seniors are a very powerful group of voters, and your opinions matter to lawmakers. Reaching out to your representatives and staying informed are powerful actions. Here is the summary of what to do. First, understand your specific income numbers. Second, research legal planning methods. Third, get professional help if the rules seem too complex. Fourth, stay aware of the policy changes in Washington. Fifth, watch out for criminals trying to steal your information. Sanders' points matter because they highlight a system that is placing more burden on retirees through a combination of inflation and confusing rules. Regardless of your opinion on his politics, the problem he describes is genuine. You worked hard for your entire life to earn your retirement. You paid into the system and made personal sacrifices. You are entitled to transparency and fairness. Stay alert and stay proactive.